There's a lot of evidence, much of which I'm sure you're all familiar with, that disparities in well-being are growing in the United States. In the paper that I'm about to discuss, I examined two aspects of the increase, especially as inequality affects the aged. First, there's the issue of income inequality. Has its trend differed in the aged population compared with the general population of the United States? Second, there's the topic of rising disparities in expected lifespans. In the early 2000s, Peter Diamond and Peter Orzog were working on a book about reforming Social Security. Peter Orzog was at Brookings at the time. Many of their policy prescriptions were premised on the idea that lifespan improvements were increasingly concentrated among people who had above average income, and more specifically, above average lifetime earnings covered by Social Security. At the time, I thought the evidence that they offered for this proposition was not awfully persuasive, and some of it had some obvious methodological flaws. But evidence in the Social Security earnings and mortality records that has been assembled since then has led me to change my mind. Hilary Waldron is responsible for the first studies that I think were pretty persuasive. Perhaps I wasn't wrong about the early methodological problems of some of the preceding research, but when the Social Security data are analyzed carefully and appropriately, it does appear that in successive generations there has been a widening gap between mortality rates experienced by people who have low socioeconomic status and people who have high socioeconomic status. In the remainder of my talk, I want to briefly outline recent developments in the old age income inequality area and also focus on new evidence about rising inequality in life chances, life expectancy. The latter evidence was developed in a project jointly with my colleagues at Brookings, including Barry Bosworth. It uses a huge data file, one that combines interview records from the Census Bureau's survey of income and program participation with Social Security records on lifetime earnings and mortality that have been matched to these survey SIEPR records. Obtaining the government's permission to access the records and assemble them is a very formidable task and also very time-consuming, which helps explain why the findings were obtained so recently, actually 10 days ago, which imposed a penalty on my poor discussant who just got the paper a couple of evenings ago. Our longer-term goal is to understand one major phenomenon and then to help policymakers think about another phenomenon. The major phenomenon I have in mind is the link between steeply rising inequality among the working age population and the transmission of that inequality to the same generations when they get past 62 or 65. How much of the inequality at age 50 is going to be reflected in the same generation when it's 65 years old, when it's 75 years old? I think that the transmission mechanism has been affected recently by the fact that retirement ages are being delayed in the United States. People are delaying when they claim Social Security pensions and when they retire. But so far, that phenomenon has been concentrated among people who are highly compensated workers, well-educated workers, and I think that this is going to affect the inequality we see, especially among people in their 60s and early 70s. The policy question raised by the increased mortality differential development is a bit different because it's a normative issue. The normative issue is how much do we want to cut the retirement incomes of low-income people who may not actually be experiencing very much of the expansion in expected lifespans. If the gains are heavily concentrated among high-income workers, shouldn't these high earners accept a lot of the reductions in benefits that may be needed to keep the retirement program solvent? Okay. So the overall Gini coefficient trend. Most of you are familiar with the fact that income inequality has risen over time. If you are familiar with the inequality statistics, they're probably from the Census Bureau, and those depend on household money income. Or they may be based on pre-tax market income received by tax filing units, if you're most familiar with the numbers published by Thomas Piketty and Emmanuel Saez. My numbers are derived in this picture from the Census Bureau CPS files, and they use the standard Census Bureau money income measure, pre-tax cash market income plus cash transfers received from the government. But I focus on family rather than household income, and I try to assess inequality at the personal level, the person level. So if I were calculating the share of income received by a quintile, it would be 20% of the people in the country, not 20% of the families or 20% of the households. Before calculating a person's or a family's income rank, unlike the Census Bureau, I convert this reported income amount into an equivalent money amount that is supposed to adjust for the fact that there are differences in family size in the families that are receiving the income. To analyze inequality within age groups, we have to decide how to classify families by someone's age. And I use the following procedure. The family's age is the age of the head of the family. And if the head is married to someone else, then it's the higher spouse's age, the spouse who's older. Okay, so enough with the details. As you know, overall income inequality has increased since the late 1970s. And here I measure the inequality using the Gini coefficient, using size-adjusted family income, but at the personal level. Between 1979 and 2002, inequality increased 27% under this metric. Almost 9/10 of the increase had occurred by the year 2000. And it has been more modest since then. If we just look at people in families headed by someone who's under 62, this picture shows what the trend has been. It's been much faster. So there's been a much steeper rise in inequality among working age families. 32% is the change in the Gini coefficient between 79 and 2012. If we superimpose on that the change in inequality among households headed by someone that is 62 or older, you can see that at the beginning of the period, 1979, older people had significantly higher inequality than people under 62, but inequality rose more slowly among the aged than among the non-aged, and at the end, the aged actually have somewhat lower inequality than the non-aged. Now, suppose we break families into families that are classified in narrow age groups than, everybody past 62. And I divided them into 3-year age groups, with the youngest people being 47 to 49, and at the top end, people being 77 to 79. This is on average what the Gini coefficient looks like across all those 3-year age groups, starting at 48, ending at 81 is the average for every family headed by someone 80 and older. This is the average across the entire span of years from 1979 to 2012. However, this was not the situation at the beginning of the period. At the beginning of the period, this is what inequality looked like across the age spectrum. As you can see, the working age people had considerably lower inequality than the aged did. And the peak level of inequality was not attained until you looked at people between 74 and 76 years old. By the end of the period, this averages the results for 2006 to 2012, the peak inequality occurred between about 62 and 67. The lowest inequality reflected in the current population survey is in fact among people past the age of 77. They have a lot lower inequality than all the younger age groups do, which is quite a change compared with the beginning of the period. The overall shift in inequality across the age spectrum is presented in this chart, which shows the percentage change in the Gini coefficient in each 3-year age group from the beginning of the period till the end of the period. And you can see the smallest change occurred at the oldest ages. The biggest change occurred at in middle age and late middle age. My hypothesis to explain this is that what we're seeing is the effects of the great increase in labor income inequality in the United States. The massive rise in labor income inequality is going to be reflected much more in the incomes of these people under the age of 60 compared to the people older than the age of 60. And the older you get, the less important earned income is in your total income. Suppose we examine what happens to single birth cohorts as they move up the age ladder from their late 40s through 80. This chart shows the evolution of inequality within just 3 cohorts as they grow older. So instead of looking at a snapshot at a point in time and saying how does inequality differ across the age spectrum, we just follow the same cohort from the time it's 47 to 49 to the time it passes out of this age range, 77 to 79. Of these 3 cohorts, there's only one cohort for which we observe this during their entire over the entire period, and that's the birth cohort born between 1930 and 32. The younger cohort, 45 to 47, was at the younger ages, and the 1915 to 1917 birth cohort was at the older ages. There's a couple of things to notice here. First is I'm only measuring bottom end inequality. This is the ratio of the 50th income percentile to the 10th income percentile. So it's the gap between people in the middle and people at the bottom. What is striking is that once you attain age 62, 63, inequality starts to fall considerably in all of these cohorts. And my conjecture to explain this is that's the age at which you can claim an early Social Security pension. That puts a floor on the income of the 10th percentile people. And the fact that none of these families, especially when you get quite old, have any earned income at all. Their income is going to be determined by the transfer incomes they receive. Here are the numbers, however, if you look for the same exact birth cohorts, but you follow them, you follow the middle to the top gap. What's the gap? The top end income gap. So this is the 90-50 ratio. And here you see that the pattern of what's occurred is quite different. Without any doubt, comparing younger, more recent cohorts with the older cohorts, inequality has increased at each age. That's pretty plain. Second, inequality doesn't fall once you get to 62 or 65. It just keeps on going up for these cohorts. Again, I think this is consistent with the idea of the rising importance of earned income in a lot of these age groups, because the earned income is being received by top income, the top income people in these classes. And so inequality is rising among the aged because I think earned income, the widening earned income gap, the fact that it is the more highly compensated workers, better educated workers that are postponing retirement, that's what's increasing the gap at the older ages. Now, let's move on to mortality differentials. Here the question is, at any given age, we already know, and we've known for many decades, that the death rates are higher for adults who have lower previous incomes, lower previous earnings, less previous educational attainment, compared with people who are more advantaged in all these areas. And there's mounting evidence that this mortality gap is growing from one generation to the next. One goal of the study that Barry and I are doing is to use matched SIP and Social Security Administration records to determine the relationship between Social Security covered earnings on the one hand and mortality developments later in people's life. We're looking for evidence in this matched SIP Social Security file that there's a growing differential by SES. The file contains information about cohorts spanning birth years from 1910 to 1956. We examine the deaths that occur between 1984 and 2012. The sample includes about 152,000 people. The ages that we're interested in are 49 to 91. What's happened to age-specific death rates in those ages? Approximately 31,000 of the survey respondents died between 1984 and 2012. Our data file contains a range of information about SES, but the main things that we're interested in is educational attainment and the effects of your mid-career Social Security earnings. Because it's the SIP file, it's not just Social Security records by themselves, it's a household survey. At the point of the survey, we know who people were married to, and we have Social Security mortality records, earnings records for those people too. And that's very important for women, because women have a socioeconomic status that is linked more to their husband's earnings plus their own than to their own earnings alone. Okay, so how can we measure low social and economic status? This would not be a challenge in these records if Social Security covered earnings were a consistent and high fraction of the total earnings that workers always had. That would be a wonderful situation. Unfortunately, that's not the situation we're in. In years up through 1980, only the amount up to the taxable ceiling in Social Security is recorded in the file. In the 1950s and 1960s, the ceiling was low in relation to the earnings distribution of men at the time. Using another and more comprehensive Social Security earnings file than the one that we're analyzing here, we discovered that when the ceiling was the lowest in the 1960s, there was one birth cohort where actual earnings reported on the Social Security covered earnings file reached a cap just above the 31st percentile of the male distribution in that particular year. Now, if we used earnings as reported in the file for that one cohort, we would obviously face a major problem, such that even very high earners would look like they have quite low earned incomes in the year where the cap is that low. Educational attainment, surprisingly, also presents real measurement problems from the perspective of identifying people's socioeconomic status. In the 1962 current population survey, 58% of the men between 48 and 52 reported that they had not completed high school. Keep that number in mind, 58% had not completed high school. In the 2010 CPS, just 11% of men between 48 and 52 reported that they had not attained a high school diploma. Our sample includes people who were 48 to 52 years old in both 1962 and in 2010, and those are, so we care about ascertaining accurately who has low socioeconomic status. Clearly, the failure to complete high school is a much more stringent marker of socioeconomic disadvantage today than it was back in 1962, when more than half the men and more than half the women who were in their late 40s and early 50s had not completed high school. My approach to these problems, both with regard to earnings and with regard to educational attainment, is to construct markers of low socioeconomic status that indicate the same relative disadvantage over successive generations. Not, did this person graduate from high school? That's not the right way to look at it, but what position in your cohort's educational distribution did you occupy is the correct way to get people's relative socioeconomic status. This approach requires that we obtain information about markers of education and Social Security covered earnings based on complete samples of people in their birth cohorts who were alive at the earliest age that we're going to start monitoring death rates. In this case, it's between 48 and 52. So I don't want to go into the details of how we do this, but think of that 31%, 31st percentile marker that I just mentioned. For the group that had earnings in the 1960s, males who were then between 41 and 50, they reached the taxable maximum Social Security amount at the 31st percentile. So we have to construct our measures of how disadvantaged people are if we want to be consistent, sticking to that 31st percentile marker. And our preferred measure of whether you're a low earner is, in the years when you had non-zero earnings, what percentage of those years did you have less than the 31st percentile income. And we can apply that consistently across every single cohort in our sample using the data available to us in this record. And so we classified anybody who had earnings below that threshold in at least 50% of the years that they had recorded earnings as a low earner. You don't have to do such a silly thing in the case of women, because the year in which they were most restricted, the woman with the 80th percentile earnings has her earnings accurately recorded in the file. Educational attainment, well, that presents another problem. A person's rank in the distribution of attainment among people born in the same year is what we're after. Now, when you stop and think about it, that's much harder to implement than you would think, because there are so many ties at exactly a high school diploma. So if you want to identify, there are a lot of years where the exact median amount of schooling is 12 years. And so it takes some effort to get around that problem. We try to do it in this paper, but let's pass on. And so let's get to the bottom line. Does the impact of socioeconomic status on mortality grow in successive birth cohorts? Well, in case I don't get a chance to present any other results, you should know the answer to that question. In our sample, we do find meaningfully large and statistically significant increases in the SES mortality differential across succeeding generations. It's getting wider. Using a person's relative earnings rank derived from the Social Security earnings file, using indicators of low and high educational attainment, in which you separate people and you say who's in the bottom half of the educational attainment distribution, how are they faring relative to people in the top half of the educational attainment distribution within a birth cohort. We obtain more reliable results when we break the larger sample into narrow age groups, and we follow exactly what happened to mortality within narrow age groups. It's a less restrictive way to see what's been happening. It doesn't matter. We still find that for the preponderance of ages from 55 to 85 or so, there has been an increase in the mortality gradient. That is, the more recent generations show a bigger differential between the death rates of low status as opposed to high status people. Okay, so this is the basic parsimonious model that we use. It's a discrete time logistic model. I think it's reasonably robust given the kind of challenges we face. It's certainly easy to estimate. Suppose we start out and we say, let's estimate this very parsimonious model across everybody, every male, distinguishing between the low earners as I just defined them, and that, by the way, that's about 43%, I think. Maybe Sita will correct me, but I think there are about 43% of the males are in this low earnings group. And this shows, if we believe the parameter estimates that we obtain, this shows what the age-specific mortality rates are for men who have low earnings, that's the blue line at the top, and men who have high earnings if they were born in 1925. So the two guys are both born in the same year. This difference between these two lines is the mortality gradient, mortality differential under this parsimonious specification from ages 50 to 90. This is what it looks like for guys born 20 years later. The red line is the low earnings guy. The purple one is the high earnings guys. The bad news is you're still gonna die. You know, that's the bad news. The good news is that your chances of dying at any given age have declined, for both the low earnings guys and the high earnings guys. But the bad news for the low earnings guy is that his chances of surviving have not improved as much as they have for the other guys. This chart makes clear how much mortality rates have improved for our sample of men who are not low earners. Okay, so the top line is the oldest cohort of men, and the bottom line, the black one, is the men born in 1940. There are 11 years, I think, from 59 to 70, where we have information in our sample in that age span for all four of these cohorts, and you can see that the death rate has gone down for these guys. Now, you might correctly complain that by adopting a very parsimonious specification, imposing it from ages from 49 to 91 for birth cohorts from 1910 to 1956, we're just putting way too much constraint on what the results are going to be, and I don't disagree with that. My logistic regression is going to pick the parameters that fit the data best over an impossibly wide range of ages and birth cohorts. That's fair. So in this chart, I show exactly the same numbers that I just reported, except I've now estimated these relationships within narrow age groups, and those highlighted dots on each line show what it is when I have narrowed the estimation to just the guys in a narrow age range. And you can see the results are almost indistinguishable in the big picture. Now suppose we use that same estimation strategy to estimate how much the mortality differential increased for low versus high earners within the 7-year age spans. Here's the answer. This chart shows the estimates. Each highlighted point on each of the lines reflects the implied estimate of the ratio of the low earner mortality rate to the high earner mortality rate at that age for a given birth cohort. So once again, the purple line is the oldest birth cohort. The black line with red circle with white circles in it, those are the guys born in 1940. And at each year of age, you can see that this is from a sequence of estimates. You can see that the gradient has increased. That is, the differential between the death rate among low-income guys is a bigger multiple in a succeeding generation compared with what it was in an earlier generation. What about women? We can estimate the numbers for the entire sample of women, and here I've calculated what the implied differential is in a different way. I say, okay, what's the percentage point difference implied by our results in the death rate that women have? So this is the excess mortality at any given age among women in these 4 cohorts. And as you can see, that percentage point differential, the extra chance that you have to die, has increased in successive generations. This is based on a marker of low socioeconomic status for women that doesn't reflect just their own earnings, but the combined information about the earnings rank of themselves plus their husband. And I think that represents an advance over what other earlier people have done. So the goal of this part of the study was to use the SIP data, match the Social Security earnings and mortality records, to answer a crucial question, and that is, can we find evidence in the matched SIP Social Security records data of any growing SES differential, and in particular, can we uncover what the shifting relationship is between mortality rates on the one hand and the average Social Security covered earnings amount that's in your lifetime earnings record on the other. If low earnings workers are seeing very little improvement in life expectancy and high earnings workers are obtaining much of the gain in life expectancy that we're seeing, we might want to try to figure out, are there ways to adjust the Social Security benefit formula to compensate low-wage workers for the fact that they are not getting the same gain in life expectancy as the better-off workers, as we trim benefits to keep them affordable, especially if one of our rationales for this is we're doing it because you're getting more years of benefits because your longevity is increasing. It might not make sense to trim them as much for the parts of the population that in fact are not participating in the gain in life expectancy. And I think I'll stop there.
discussant is Sita, Slavov of George Mason University.
Great, thanks. Yeah. So I'll start by saying I really enjoyed reading this paper. I thought Gary did a good job of assembling some really interesting data sets and exploring some very important questions. So I'll start with a brief summary of sort of what I took away from the paper. It's a well-known fact that income inequality has increased, and the amount by which it's increased varies depending on how you measure income, but pretty much no matter how you slice it, income inequality has increased, and that's sort of overall in the population. What I think is less well-known, and what I think Gary did a very nice job of illustrating, is some of the facts regarding income inequality among older people and how income inequality evolves over sort of the lifespan. And in particular, the increase in inequality has been smaller among older people. And the increase in top half inequality plays a larger role in driving the increase in inequality among these older age groups. Inequality actually declines with age in the lower half of the distribution, starting at age 62. And the explanation that Gary proposes is the role that public benefits, Social Security in particular, play at older ages in boosting incomes at the lower end, which I think is kind of an interesting insight. I think Gary also does a very nice job of documenting that between income group mortality inequality has increased. And so I think this is a really careful analysis of some large and rich data sets, and in particular, income differentiated mortality is really hard to measure, because looking at the correlation between annual income and mortality gives you a biased picture, because death is often preceded by illness, which causes incomes to fall. So Gary does this by sort of looking at full earnings histories from the Social Security Administration. He addresses this, and he's able to look at lifetime income category, which he proxies by earnings between the ages of 41 and 50, and mortality. So I know this paper is in early stages, so what I'm going to focus on here is sort of the direction that I'm hoping that Gary will take this, the things that sort of I'm interested in learning. The main thing I'm interested in is sort of more of a sort of big picture story, sort of fleshing out a big picture story. So there's this piece analyzing income inequality at older ages and how that's evolved, and then mortality inequality and how that's evolved. I'd like to see more of a connection between the two, which is, I think, the direction that Gary might be going, because he suggests that it's sort of in the context of the policy implications of raising the retirement age, right? So I think this sort of gets at sort of what is the connection there. His income inequality analysis, that's all based on sort of annual income, which is fairly standard in papers that look at income inequality. But the mortality differences and the retirement age issue are really about lifetime income, right? So the mortality differences arise from different lifetime income categories, and this issue of whether raising the retirement age disproportionately affects low-income workers really has to do with the fact that so you receive less in lifetime benefits if you don't live as long. So I think sort of this putting everything in the context of lifetime income and making that connection between income inequality at older ages and this mortality inequality issue could be interesting. In addition, so Gary points out that this progressive Social Security benefit formula reduces income inequality among older people, but that formula is going to look less progressive in light of mortality differences by income that have apparently been growing, right? So I think that could be an interesting thing to explore. I think it's also interesting that he's documented that income and income inequality vary so much over the life cycle, which he illustrates nicely, and I think that also sort of underscores the importance of the lifetime perspective. So you document that there's not too much income inequality among, say, 80-year-olds, but maybe earlier in their lives, these same 80-year-olds, there was a lot of income inequality, right? So now just a few more detailed comments about the analysis. So first, in terms of the analysis of income inequality, I would be kind of interested to know what is the role of market income versus post-tax and transfer income in driving income inequality at older ages, right? Because the explanation for lower income inequality at older ages is because there are these public transfers. So I wonder how high would income inequality be without those transfers? I'd also be interested in learning more about the role of in-kind transfers at older ages. So this is a measurement issue in the CPS data. It includes cash transfers, but not in-kind transfers, most notably healthcare benefits. So whether that's employer-provided benefits or things like Medicare. And I know Gary cites in his paper a recent CBO study that shows, including these in-kind transfers doesn't really change the overall upward trend in income inequality. I'd be interested to know how this affects specifically inequality at older ages, because I would guess that a large number of individuals there get pretty substantial in-kind transfers from Medicare. This is more in terms of measuring men's versus women's mortality inequality. Gary says he uses own earnings for men and spouses' earnings for married women, which makes sense because if you had a non-earning spouse, you would not want to classify that person as low income if they were married to someone who was high income. The question that I had in reading this is, would these results change if household income were used for both partners? Because really that's the approach taken in the income inequality portion of the paper, right? And the idea here is that households pool resources. And I think it's widely sort of agreed that some kind of household-based measure, and you can adjust it for household size and do it on an individual basis, but households do share resources. So I think in particular with the mortality inequality stuff, it could affect the classification of one earner versus two earner couples. The other issue I would be interested in learning more about is income mobility among older people. So I mean, that's kind of very closely related to this issue of income inequality, right? So it's been studied for the population as a whole, and my hunch is that while income inequality might be lower among older people, mobility might be too. And then finally, I'd kind of be interested in knowing, I know John and I have sort of documented that people have been delaying Social Security a little bit more, in particular since the deal has gotten substantially better starting in around 2000. And I know Gary's research suggests that those gains have, so it's disproportionately become a better deal for higher income individuals. So I'd be interested in seeing if you could document whether these Social Security delays are concentrated among high-income individuals, right? So I think John and I have shown it's delaying Social Security is still a pretty good deal, even if your mortality is twice the average, right? But it's an even better deal if your mortality is the average or better than average. So I'd just be interested in, and I think if you have the Social Security benefit records too, you might be able to do that. And I'm also curious to see eventually what policy recommendations Gary produces based on this. So should the normal retirement age be tied to lifetime income, for example? And there's this Social Security, there's this actuarial adjustment depending on claiming age, and maybe that should vary by lifetime income. So I'd be interested to know sort of what policy implications you get from this. And I think I'll stop there. That's about all I had to say, but thanks for an interesting paper.
Gary, this may be the same question that Sita may have asked. I'll ask it slightly differently. Is your specification flexible enough that the mortality difference could change at 65 when everybody's on Medicare? Does it make any difference that the health care becomes more equitable starting at 65?
Yeah, I mean, there's a lot of specification changes we could make, including the one that Sita recommended, and I agree with her. You could come up with a marker for low family income for both sexes. You don't have to just do it for women, but the results for men based on their own earnings are so powerful that I stop there. And the challenge is what to do about women, because when you use women's own earnings, it's less good. Can I just answer a couple of her questions? One connection between the two parts of the paper might have occurred to people sitting in listening to me, and it certainly occurred to me. Remember, I'm considering the growth in inequality, and I'm saying it's linked to the fact that now, for higher income people, earnings last until later in life than they used to. Well, it could be that more affluent workers recognize their lifespans are increasing, and lower income workers realize that their lifespans actually are not increasing very much, in which case the fact that this trend toward later retirement is so far been more concentrated among high education, high income workers than amongst those with less education and less earnings could just be a logical result. Now, it would demand an awful lot of knowledge about what the mortality statistics look like, and it could very well be that there isn't that much information, but that occurs to me as a potential link between the two parts of the paper. Adding in-kind benefits would dramatically change, I think, inequality measures for the aged population, because the government, through Medicare, is essentially giving everybody a $6,000 to $10,000 insurance policy. That's the value of the government subsidy, and it's actually a little bit bigger for the people who are lower income, because their premium for Part B insurance is very low, and that of affluent people is quite a bit higher, because the premium for Part B insurance is linked to your income. So without a doubt, if I could come up with an ideal measure of the value of these insurance, it would make inequality look less among the aged.
Far back, I think we have.
Yeah, Gary. So you sort of talked about these issues with the education distribution shifting to the right and the taxable earnings threshold changing over time. I wonder, there's another one that I was thinking of, and I don't know how you think about it in this framework, is just the greater likelihood that all people will make it to age 70 or 75. So the composition of people at 70 or at 75, as you look across these long time periods, is going to be somewhat different, and by income, because those probabilities have changed a lot over time. And I don't know to what extent that adjusting, there's all these compositional issues, but I don't know to what extent, that would drive or attenuate some of the sort of growth and disparity that you're documenting. Does that make sense?
Well, I have seen in the biomedical literature that examines the phenomenon of what's the relationship between previous income or status and later mortality rates, that they do, the occasional doctor will say something like, well, by the time you get to age 90, the differential is small because the low-income survivors at that age are so self-selected from the low-income population that they're actually quite healthy people, and that may be true. And I think it's the same phenomenon you're talking about. But actually, I'm just trying to do the naive thing, because it's so hard to even do the naive thing, because to get this kind of data is just an incredible challenge. So I'm just trying to do the most simple possible thing. John's suggestion that I try to see whether there's a change exactly at age 65, which is a great suggestion, by the way. It's not one that occurred to me while I was doing this. But yes, you can do it using the method where you slice people by the age and you try to see in the just beyond 65, does the mortality gradient shrink? You could do that. And I believe some people have tried to get at that issue. And we could too, but look, this is early innings. These results were obtained 10 days ago. So.
Do you think it amplifies or attenuates this issue?
Well, I take on faith that the doctors were right on this one, that by age 90, no, 90 is one of the ages we look at, although very little is significant at 90, I have to say. And also the gradient is smaller there, just like the doctors predicted, or the doctors have claimed in past research.
I'm curious whether you thought about, I know you can't do it with these data, but you thought about the role of health and health behaviors in this, right? Because you see these widening sort of mortality differences, and I don't know if, the greater disparity in smoking behavior, greater disparities in obesity and those kind of things. Because think about this normatively, that issue is quite important, right? To what extent is, bad health because you're low income and therefore it's sort of the lot you've been dealt? To what extent is it different choices people in different socioeconomic groups are making, and therefore thinking about whether we sort of do want to, correct for it after the fact by changing normal retirement ages, whatever, looks a little different.
David Cutler has looked into that, I think maybe with some co-authors. Barry Bosworth and I wrote a paper earlier this summer in which we used the Health and Retirement Survey data linked to Social Security records. And the Health and Retirement Survey data have information about health behaviors and also about mortality experience of your parents. And we tried to see whether these behavioral differences, do you exercise, do you, the interviewer's assessment of whether the person is overweight or not, smoking behavior, drinking, how much do you drink. I have to say that even putting those in as controls, as sort of, let's assume that all these things were happening when people were 50. Now, what's their subsequent mortality experience? It didn't change the finding that the mortality gradient is widened, meaning that the way you might look at this is, how much does it reduce the estimated effect of socioeconomic status that you have a separate control already for these behaviors? And, it didn't change things very much. That was the surprise to us. I mean, we thought that was going to be a major part of the explanation.
Gary, a couple of things I'd be interested in seeing. Maybe on that question of using the household earnings for males, I think what could make that interesting is that I think over time we've seen the degree of positive assortative mating increase. And so what you describe as striking results for men could become even more striking when you count their total household income, because doctors are marrying lawyers more and more. So that's my pitch for that. The other thing I'd be interested in is that link between mortality and economic status. I think is the exception there is Hispanics, lower than average economic status, but they do tend to live longer. So I'd be curious to see if there's anything you can do about that. And it's probably difficult because there's a lot of immigrants there and you don't have full career earnings there, but that's my question there.
The assortative mating is tougher than you think. I mean, it's true that there's a higher correlation between the earned incomes of husbands and wives in 2014 than there was in 1960. I say that based on almost certainty because there was a higher correlation in 2000 than there was in 1960. But as astonishing as it may seem, the correlation between educational attainment between those 2 years didn't change. What changed was the behavior of women. I think sociologists have gotten this one wrong because their marker of your educational attainment is, have you got a college degree? And they say, look, the percentage of college graduates who have married a college graduate has gone up. Well, of course it has. If only 9% of the population had a college diploma, then a lot higher share of college graduates in that world would have non-college mates than in a world where there's 30% college graduates in both sexes. I mean, that is just one of the most elementary errors in determining how much assortative mating there is. But if instead you say, what is the rank correlation of the husband's educational attainment and the wife's educational attainment, comparing the census data from the 50s, late 50s, and today does not show a huge difference. Now, maybe I'm wrong. Maybe things have evolved since the last time I checked this. But so The assortative mating that a lot of people think they see is that the correlation between how much husbands and wives earn has gone up. But I think that is driven by a big change in the behavior of well-educated women who are married to well-educated men. They're doing different things. How many college presidents, male college presidents, in 1959 had a working spouse? How many don't have a working spouse now? I mean, it's just a completely different world. And so the fact that the earnings correlation has gone up a lot represents really a change in behavior more than but not the behavior of who you're marrying, I think.
I thought doctors were marrying lawyers to hedge the risk of malpractice.
Thanks, Gary, for a very interesting talk. I just had a question about the object of inquiry, which is why shouldn't we be looking at wealth inequality as a very important input into policy decisions? I would imagine that wealth inequality has always been larger for older ages than for younger ages, and that it's probably been exacerbated over time. There may well even be even bigger differences in wealth inequality now, and especially in a world of increasing defined contribution pension plans, 401ks, where some are just doing their own drawdown schemes on their own, on their own resources. It would seem that wealth inequality will also be an important object to look at.
Well, the last time I checked, the Fed turned over profits to the United States Treasury of about $70 billion, so they have plenty of money to finance this. And fortunately, they are also the agency that collects the best individual level wealth data. So if we can persuade the Fed to use some of its $70 billion profits for this truly useful thing as opposed to wasting it on the general treasury, maybe we can get the wealth data linked to mortality data. I mean, really the reason Social Security has such fantastic mortality data is they want to know when you die. They don't want to send unnecessary checks to living people. And so they want to know when if you die at 39. They don't care. They really want to know when you're dead. But the Fed, they don't care when you're dead, as far as I can tell, and so they don't link their wealth data with mortality data. And that's really what you need to get, I think, this connection.
We get a mic over here. Steve, here, you can have this one in the meantime. We'll get Steve and then Mike.
I've seen some headlines that say that the mortality is actually getting worse for the low-income people, whereas if I heard you right, it just wasn't increasing as well as, or improving as well as it was for the high income. But I'm just curious, did you see an absolute decrease in mortality? No, I'm sorry. Well, absolute getting worse of mortality, or was it just relative?
That paper received a lot of attention, and fortunately it was available for free, at least for a week or so after there was a news article about it. And so I went and read the article, the scientific article. I think they made the mistake of assuming that having less than a high school diploma was the same marker of disadvantage in 2014 as it was in 1970. And it's not. It is a drastically more selected, adversely affected population in 2014 than it was even in 1970. An astonishing statistic is, in the late 1960s, in 69 I think, more than half the hours supplied by workers in the United States in that year were supplied by people who had not completed high school. 1969. Now, people just don't realize what a huge transformation there's been in the educational attainment of people at different ages. So those numbers that I gave you for 48 to 52 years old, 58% were dropouts in 1962, 11% were dropouts in 2010. I mean, it's an immense change, and to treat less than high school diploma as the same marker of disadvantage in 2 years separated by 40, is not a legitimate test of the hypothesis. Are you more disadvantaged today? You're more disadvantaged for sure today if you haven't completed high school. That's true. But does it indicate that the mortality gradients in the way you want to think about this are actually widening? And I think that that study that said that women with less than high school diploma have seen declining life expectancy is based on that very straightforward error.
Mike, the last question.
I didn't hear you take a stand on causality here, although there's been
Between-
some hint in the
Which-
discussion, a stand on causality. That is causality flowing from income to mortality. In the literature, that tends to be what epidemiologists go to, but in economics literature, not at all, I would say. And I would say the change in income inequality and mortality inequality needs to be investigated as to a causal path. I would not link those two things together necessarily. A second comment has to do with your possibly even dismissal about the causal role of education. Among epidemiologists, there's certainly a strong belief that education is causal for mortality in the accumulation of human capital and ways of coping with life and other things. And your approach takes exactly the opposite point of view, where education is simply a marker for underlying fitness, basically. Your percentile point in the percentile education distribution says that education is a sorting device rather than a human capital accumulation device. I think the truth is between those two things.
I do too.
And it would be interesting to see how sensitive your results are to a different approach that takes seriously that education actually does something for mortality.
I completely agree with you on both parts. I didn't take a stand on causality. Sita said that that's what she wants the direction of research to be. Is it the fact that rising inequality over the last 30-some years has produced this increasing gradient in mortality? I don't take any stand on that question whatsoever, so I completely agree with you. And I don't know where I would begin, actually. I'm just trying to link these two literatures by, having us think at the same time about income inequality and the disparity in expected lifespans. With regard to education, you're completely right. My now deceased colleague, Ed Dennison, he thought that the addition of education was causal in productivity growth. And if I remember his estimates from the 1960s, he said, of the total growth of productivity in the United States, 1929 to 1962, I think he said rising education was like a third of the total explanation. So, he thought that education itself as a pure marker was generating this, and he had some sophisticated ways to tease this out. And I think you're right that a lot of people believe that if you give people 6 more years of formal schooling, their health behaviors, their nutrition, their willingness and ability to see doctors under the right circumstances all change, as do their life chances. Another explanation, however, is that there have been huge improvements in public health which don't require people to know very much of anything. And I have heard claims that 80% of all the improvements in longevity from the middle of the 19th century to the middle of the 20th century are those pure general public health things. There's no agency on the part of individual human beings that got them to have such long life expectancy. We just had better sewage, we had better water, we had better, I don't know, whatever else improves generally. And consequently, everybody got the benefits of those lifespan gains. And I think you're right that the answer, whether education is a relative marker of fitness or whether it absolutely is contributing to the drop in inequality, it's probably part of both.
Okay, time for a line change.